Hello and welcome to Energy Insights, your source for the latest energy analysis across the globe. So today we are covering the global energy market overview, geopolitical gas expansion project, oil price collapse and the crash asset repricing. We will cover our today's episode under three segments. So starting from the segment one, which is related to the oil markets, latest informations. So let's start from the segment one. Oil markets plunge 10% as Strait of Hormuz reopens, easing the geopolitical risk premium. So this is our analytical topic for this session. Global oil markets experienced a sharp sell-off after Iran announced that the Strait of Hormuz had been declared fully open for the commercial shipping during the ongoing ceasefire period, triggering an immediate collapse in the geopolitical risk premium built into the crude prices. The Brent and the WTI crude both fell by around 10% with US benchmark, which the WTI price slipping below the mid $80 per barrel range, marking a multi-week low. So the decline was driven by easing fears of supply disruption through the world's most critical oil transit choke point, which typically carries around one-fifth of the global seaborne oil flows. So the announcement was accompanied by confirming from the US president that the maritime passage through the strait had resumed, while noting that broader geopolitical conditions remain tight to the fragile ceasefire framework. Markets reacted swiftly, interpreting the development as a near-term de-escalation in the Middle East supply risks. However, analysts cautioned that the price collapse reflects sentiment-driven repricing rather than a structural resolution. While tanker flows may resume, uncertainty persists regarding the durability of the ceasefire, insurance costs for shipping and the operational stability of the transit route through the strait. Traders also highlighted that the oil sell-off was amplified by the speculative positioning, with recent long positions unwound rapidly following the announcement. Energy markets, which had priced in prolonged disruption scenarios, are now reassessing supply expectations as physical flows potentially normalize. So despite the sharp correction, underlying fundamentals, including tight global inventories and ongoing regional tensions, continue to support a volatile outlook. Analysts broadly view the move as a short-term relief rally in supply chain rather than a definitive resolution of the geopolitical risk in the global oil markets. So that cover our today's session one. Now we have to dive into the segment 2 with the China-Turkmenistan gas cooperation, and they enters to a new expansion phase amid the major field breakthrough. China and Turkmenistan have further strengthened their long-standing energy partnership with the official launch of new development phase as the giant Galkynysh gas field, marking another major step in the deepening the Central Asia-China energy integration. The groundbreaking ceremony held in Turkmenistan, Karakum Desert, formally initiated the fourth phase of expansion at one of the world's largest natural gas fields. So the project is being developed by the China National Petroleum Corporation (CNPC) and is designed to significantly expand production capacity, reinforcing Turkmenistan's role in core supplier of the pipeline gas to China. Chinese Vice Premier Deng Zhang attended the ceremony as the special representative of the President of Republic of China, underscoring the strategic importance Beijing places on energy security and long-term supply stability. He reaffirmed China's commitment to expanding cooperation in natural gas and strengthening infrastructure development under the broader bilateral and regional frameworks. So the Galkynysh expansion is expected to add substantial new processing capacity and further increase gas output, destined primarily for China, which already receives the majority of Turkmenistan gas exports through existing Central Asia-China pipeline networks. Officials from both sides described the project as a continuation of strategic, mutually beneficial cooperation in the energy sector, while also signaling interest in expanding collaboration into adjacent sectors such as connectivity and industrial development. So the development comes at a time when China is actively reinforcing energy diversification strategies and strengthening overland supply routes from the Central Asia, reducing exposure to maritime choke points and the global market volatility. Turkmenistan, holding some of the world's largest gas reserves, remains central to this long-term supply architecture. The new phase at Galkynysh, therefore, not only an upstream expansion project but also a key element in evolving China Central Asia energy corridor with implications for regional gas trade flows and future pipeline infrastructure development. So this concludes our segment 2, and now we are to look into the final segment, the segment 3, the market overview. Today's energy market session was defined by the broader risk of correction in crude oil, sharp weakness in refined products, and relative stability in the gas in LNG, reflecting a clear shift from the geopolitical risk pricing toward fundamental driven valuation. So, in case of crude oil, a broader based decline across benchmarks observed. So, crude oil experienced a synchronized downward adjustment across all major benchmarks compared to a previous session. The WTI crude traded at $83.85 per barrel, down by around 10.25%. Similarly, the Brent crude traded at $90.38 also per barrel, down by around 9.07%. The Morban crude traded at $91.70, which also dropped by 9.8% in comparison of yesterday price. The WTI Midland $86.76, also down by around 11.91%. OPEC basket traded at $104.79, also moved by upside relatively 0.22%. The key takeaway is the divergence between the financial and physical pricing. Future linked benchmarks like WTI, Brent, Morban recorded steep losses, while the OPEC basket remained stable to slightly positive, indicating that the physical supply demand fundamentals remain intact despite financial market correction. In the refined products markets, a strong downside pressure led by diesel also been observed. So refined products reflected a more pronounced demand signal compared to the crude. Gasoline traded at around $3 per gallon, which showed a downward movement of around 4.79% in comparison of yesterday price. The heating oil diesel traded at $3.44 per gallon, a downward movement being observed by around 10.36% comparison of yesterday price. So diesel led the downside, signaling weakening industrial and freight demand expectations, normalization of previously tight middle distillate balances, increased sensitivity to macroeconomic growth outlook. Gasoline showed a more moderate decline, suggesting relatively stable end user consumption compared to industrial fuels. In case of natural gas, marginal strength amid oil weakness observed. The natural gas moved counter to crude oil trend. The Henry Hub gas traded at $2.68 per MMBTU, which showed an upward movement of 1.25%. Eco natural gas traded by around $0.97 per MMBTU, traded upside by around 2.11%. The divergent highlights that the natural gas remains primarily driven by domestic fundamentals, including storage levels, weather conditions, and power demand, rather than the global geopolitical oil dynamics. In case of LNG markets, being observed stable in Asia and slight strengthen in Europe. So the LNG benchmarks remain comparatively steady. In case of the Asian benchmark, the JKM, Japan Korea marker, traded price remained $19.20 per MMBTU, which as of the yesterday price, no change being observed there. In case of the TTF, the European benchmark, traded at $14.66, which showed a slight upside movement, 2.25% in comparison of yesterday price. Asia LNG stability reflects balanced import demand, while the European pricing shows mild tightening, likely linked to storage and seasonal balancing factors. LNG continues to demonstrate partial decoupling from the crude oil volatility. So today's session reflects a clear structure adjustment across the energy complex. Crude oil experienced sharp correction driven by removal of geopolitical risk premium. Refined products, especially diesel, signaled early demand softness in the industrial sector. Natural gas and LNG remained anchored to the regional fundamental rather than global sentiment. Overall, the market is transitioning from the geopolitically driven pricing phase into a fundamentals driven phase, where crude adjusts rapidly, products reflect demand expectation, and natural gas and LNG remains structurally stable. So this concludes our today's analysis. Thank you for watching Energy Insights. If you like this analysis, please subscribe and hit the like button. Thank you for watching Energy Insights.